Welcome to another CEO Wisdom podcast with Karim Nanji with us today. He's CEO at Inverite Insights Inc. We're going to talk about Inverite, which is a very cool company that's publicly listed. This is the future of financial data, basically. So we're talking about verifications here made through machine learning. It's a cool fintech, quote unquote. So we're going to talk about their business model, about what they're up to, their growth plan for this year. This podcast is presented to you by podbuyer.com. If you want to start or scale a podcast, go to podbuyer.com. Karim, welcome to the pod. Tell me a bit more about yourself and what you're up to nowadays.
Hey, Charles, thanks for having me. Appreciate the chance to speak to you. As you mentioned, I am the CEO of Inverite Insights. We are a company that's dedicated to transforming the lending industry and lending decisions through the adoption of advanced technology and alternative data. And we can talk more about that as we go on. The cornerstone of our strategy is to leverage artificial intelligence, machine learning, and extensive data analysis that kind of extends beyond traditional financial metrics. We integrate a broader spectrum of predictive indicators that allows for lenders to do a more wholesome and robust credit assessment on creditworthiness.
Right. So you sell to lenders a solution that would have them do a more thorough background check before they lend the money so that people don't run away with their money.
Well, yeah, exactly. Well, yeah. So I'll get into a little bit details, but from a layman's perspective, you're correct, right? The lender is adjudicating a customer who wants to borrow from them, and over the course of the last 2 or 3 years, with COVID, recessionary background, higher interest rates, there's a mass migration of consumers away from traditional financial institutions. They just cannot get credit by walking into their bank. Now, 80%, Canada is a very highly banked nation. So a big portion of our customers are 80% of them deal with the top 5, 6 institutions. So if you're not getting money there, you're moving to the alternative lending industry. And in that space, we're finding that traditional credit scores are not really applicable because they're very backwards looking. And alternative data, especially spending data, transactional data, data that happens in each one of our bank accounts, is more predictive of an individual's ability to make a payment, right? So we take that data and we provide it in a very advanced way to our lenders so they can make a credit decision, because their main goal is they want to lend money. That's their business model. They get a return on that money, and they want to make sure that they're paid back.
Right. How do you get your new customers? How do you get to market?
So how we get our customers, so we're a B2B2C company. The consumers that we deal with are actually the consumers of our lenders, whether they're in brick and mortar locations or they're online. COVID also showed a mass migration of consumers learning how to deal online for the first time, including things like Zoom or video conferencing. A lot of transactions started to move online. That created another problem that kind of goes back to one of the first things that you said, Charles, which is we do also have technology that allows the lender to be able to make sure and reduce the amount of fraud that's happening up front, because online transactions are open to inefficiencies. But going back to your question, so we're a B2B2C company. We market to our lenders either online or through referrals, just a normal sales process where we're onboarding lenders that are looking for ways to be able to get more approvals, reduce declines, and get more data. Imagine if you knew exactly the date to take the payment out of your customer's account, because that's where they had the most money, right? So those are the type of analytics we can provide that helps automate operations for the lenders and reduce costs.
Right. And your main growth channels, ads, LinkedIn outreach, like how precisely do you get all these new customers?
Right. So there are online methods that we use, whether it's LinkedIn or through third-party aggregators that help us find individuals who are decision makers in the specific industry. Right. In some cases, it could be the chief marketing officer. In the other instances, you have the chief risk officer. So depending on what it is that we're actually marketing at that time, we've got a solution that allows the lender to get data from their consumer. And then there's some ancillary services such as confidence scores, AI-based risk scores that can give the lender the probability to that the individual is going to pay or the likelihood they're going to default. But the marketing and the onboarding of the customer and the marketing is a traditional marketing problem. And we use various sources and databases to be able to reach out. We're part of associations. So people do know us, and through SEO and other methods, lenders or people who are looking for these type of services, alternative data, are able to find us, or we go out and we find and market to them.
Right, because selling to banks is not easy. It's somewhat of a bureaucratic process, is it? Like, and sales cycle can be quite long, if I'm not mistaken.
Yeah, you're absolutely right. When you're dealing with larger enterprise customers, the sales cycles are traditionally longer. A lot of functional groups, the left hand needs to talk to the right hand, and there's a lot of layers, right? And so when you're dealing with top tier financial institutions, just like in any industry, whether you're selling software, larger organizations have the sales cycles are typically longer. But when you're dealing with in the alternative finance space or you're dealing with lenders, from a technology perspective, it's really not hard to get up and off the ground. You can be up and running from contract to signing, and you can be up and running within hours and days, right? Depending on your own process. The whole point of this solution is to be able to provide you data for you to make a decision. But sales cycles for large organizations are typically longer. Our focus has been very much over the last little while in the small, medium size a market. But over the course of the last couple of years, as the federal governments, both here in the United States, the topic of consumer-directed banking or open banking is what it's traditionally was called as. Once that starts getting momentum, representatives in each organization are very much like Y2K are preparing for the day after. What does open banking mean? And open banking is just basically giving the power of the consumer's data to the consumer so they can do what they want with it. They can share it with whoever they want in order for them to get the value that they're looking for. It could be a landlord, it could be a lender, it could be at the finance shop in the car dealership. There's so many different applications of this data.
Right. And who are you competing against in this market, and how do you make sure that you're different from their solution?
Yeah, so in Canada, there's a couple of Canadian homegrown companies. We're one of them. Another company based out of, and I'll give them a free plug, based out of Montreal, is a company called Flinks. They're owned by National Bank predominantly. But there's large companies in the United States, to give you an indication. Plaid is the largest company in the United States. They've made a foray into Canada. But they're based in the United States. And Plaid is a company that Visa tried to acquire. I believe it was for about $6 billion 2 or 3 years ago. There's other companies like MX or Finicity, Intuit. The technology behind getting data from the consumer is very similar to what you're seeing on finance apps. If you download them off the on your mobile phone, these type of technologies, with the consumer's consent, get banking information, and they can turn it into, you can easily turn it into a budget, right? That's what consumers use it for. But imagine what the lender or the person offering the service is looking for. They want to know a little bit more about you, whether it is to make sure you are who you say you are, whether it means to verify your age, or it could be, give me some additional data so I can offer a credit decision, whether it's a credit card company or a mortgage company. And in a lot of cases too, with the consumer's consent, I think we've all been in situations where a landlord asks you for a void check, or a lender says, give me a copy of your void check so I can take money out of your bank account. So there's a lot of data that comes in electronically that can facilitate an automated transaction to help speed up the transaction itself.
Right. How many clients do you currently have, and how much do you aim to have by the end of this year?
So we in our ecosystem, we have 200 lenders, Canadian-based lenders, vendors. Um, and those they're not necessarily all just lenders. I should clarify that. It's a combination of lenders and technology systems that provide services to other lenders. So we have let's call them aggregators, right? They're providing solutions to a lot of lenders, and one of the services that they provide through the lender is our service, right? So it's kind of like a reseller model. We hope to double that by the end of 2024. Double that in terms of increasing also our technology integrations with other technology companies and other platforms, right? So it's all more or less becoming not just signing up individual lenders, but how we can embed. It's very much embedded finance, where you're embedding yourself in technology or lending platforms, loan management systems, origination systems, mortgage systems that leverage this data in order for them to do what they're doing, right?
Right, because if I try, I think I tried some login or verification things with my Canadian bank, and it was indeed Plaid. Um, so yeah, and 6 billion, yeah, it's a humongous company. What's your plan? I mean, your stock listed. Uh, is it to be acquired in 5 to 10 years down the road, or is it just to grow through acquisitions?
Well, I think we want to continue to grow the company. There's opportunities for us to potentially do additional acquisitions. That said, there is a lot of interest in this space, Charles, both on this side of the border as well as south of the border. And we just recently did a news release this morning that speaks about a technology partnership with a company based out of India that both helps us in the development and the technology capacity, but our technology is very relevant in other areas of the globe, especially the global south, where Fincuro operates, where financial inclusion, open banking are in different states than they are where we are in North America, right? So we don't have open banking. We're moving in that direction. The feds will announce that in their budget. Similar types of things are happening in the United States, but in other areas of the global economy, open banking is already there, right? And so how do we use data and artificial intelligence and machine learning to be able to provide that service? So the reason why I kind of took that detour there, Charles, is to be able to say that there is a lot of consolidation, potential acquisition in this market, as we've seen by the evidence I provided you with Plaid and Visa. And so we don't know. Our goal is to continue to grow this company. If there's an opportunity to expand our strategy or accelerate our strategy with products that can help us grow faster, or potentially acquire accretive revenue and EBITDA, that's also opportunities that I see in the future going forward. But some of the players in the industry, especially when you're looking at open banking and the banks getting involved, uh, you could see us to be potential prime target for an acquisition within a couple of years.
Right. And what are the trends that you're seeing this year in fintech? What has changed? What will change this year vs last year?
Well, if we're talking about alternative data, uh, you're now going to find in the Canadian budget where there's a move towards using rent as a way to report to the credit bureaus. If you look at it, let's look at it in general, it's probably the single largest payment that most consumers in North America make. Imagine making rent payments every month for 5 years and then it not reflecting on your credit history, and then you go apply for a loan and you get declined, right? This is very difficult for young adults, right? They're paying rent and then they get their first job and they need a credit card or they need a car and there's no credit. So basically, that is a sign of where things are moving with respect to alternative data. The generation that I come from a different generation, but when I'm looking at my kids and older, they're very much we're in a world of the Netflix generation. I want what I want when I want it. I don't want to have to own it, but I can rent it. And you see that with a lot of buy now, pay later. A lot of people are buying now, paying later, but those type of transactions are not being reported in traditionally as a whole into credit reporting agencies. But it is obviously, and I think the major type of trend you're going to see is the convergence of payments and credit. Right, buy now, pay later is the perfect example of paying. I can't afford $1,000, but I can afford $90 a month, right? And then you're getting credit for the rest. So you're seeing a convergence on that side. Open banking itself is going to open up a lot of new opportunities. Fintechs are going to be able to get a fair a playing field to be able to compete and provide services to consumers. You'll see partnerships, more of them with banks and fintechs. Those type of discussions are already happening, and you're starting to see people to get prepared for the unknown a little bit. But generally, open competition with fair with open banking and fair competition levels a playing field and allows innovative solutions to go out to the consumers so they can decide who they want to use and move forward from there, right? So I don't look at necessarily as disruption, but more evolution. You also see the role AI and machine learning is playing towards automation. With alternative data, lenders are going to look for easy ways to, by easy, I mean simpler ways, automated ways to be able to make decisions on this alternative data. And then you're going to see, I believe credit scoring models change with the incorporation of more incorporation of spending patterns, activities. When our technology, we're able to see Charles, how much Charles makes, who he pays, when he pays, how often he pays. We know who your vendors are. There's a lot of data that can be used to provide services back to the consumer. So it does put the power back into the consumer's hands in very creative ways.
Right. And what do you foresee for the economy? Because you mentioned all these packages that were sent to people during COVID's. People lived big and seems to have debts to repay nowadays. Inflation is still rising, a bit less than I believe than in 2023. But what are you foreseeing in terms of consumers, their spending, and the economy in the next couple of years?
Yeah, so consumers, we spend quite a bit, and it's also very expensive here. What's happened with higher interest rates and there's a few things that have happened in the industry, right? So the top tier financial institutions have tightened their credit policy, so not the same person who was getting a loan last year is not qualifying this year. You've seen with higher interest rates and inflation, the cost to with respect to transportation, with food, with housing has all increased. So with income not increasing in the same with the same correlation, there's less money to go around for other things. And so, but consumers like to spend. And in Canada, we for every dollar of disposable income, Canadians carry about $1.80 of debt. So we borrow quite a bit. So that puts a real strain on individuals' ability to make payments. And it puts a strain on financial institutions who make their bread and butter in lending, right? Like I deposit $1, so my institution can lend it to somebody at X. But if it's harder to get repaid, the challenge is that there is capacity for consumers to pay, but our conventional ways of credit assessment need to be more advanced, right? There is capacity, but people are getting declined. At the same time, the feds last year reduced the criminal code of interest from just under 60 to the mid 30s, which has made it very difficult for some lenders to lend based on their own risk reward trade off, right? So a lender may be willing to lend to a consumer if they were getting 39% APR, but not if they're going to get a 29% APR, right? Because of the inherent risk. But with the type of data that we can provide that is very predictive, it can give lenders a lot more comfort on individuals. We can see trends happening well in advance, right? If there was an NSF, like we can, it sends off an alarm bell, which is why did this happen? And lenders can be alerted and do mitigation, curative actions, right? Lenders right now are working very hard with their borrowers as mortgage renewals come up to work with these lenders in figuring out solutions. Now, but you bring up a very good point, because during COVID, there was a lot of stimulus checks, and so there was a lot of cash flow. If I'm not driving and paying for parking downtown, if I'm not going to the movie theater twice a month or stopping off at Tim Hortons on the way to work, I've got a lot more disposable cash, right? No babysitters or things like that. So people were paying down their debt. Credit scores actually saw a lift during COVID. At the same time, Charles, there was a lot of loan deferrals and forbearance where borrowers were getting a relief from making a payment. So all this data has kind of done a real number on traditional credit scoring systems, because there was something really out of the blue that happened, and they're not really indicative of credit health of a consumer. In some ways, things were artificially inflated, and so I do see that there's still going to be a strain on consumers. There's going to continue to be a massive migration of consumers into alternative lending, and in alternative lending, the traditional credit score is more irrelevant than not, and so alternative data is going to continue to be very important.
Where can people find out more about you, Karim?
Our public-facing company, InveriteInsights.com, tells us a little bit more about the company in general. Inverite.com is also a site where it tells us more about our products and what we're doing as a company on the business level. And more information is there. There's channels in there where you could reach out for customer support or more information. We're happy to talk to everybody, whether it's potential partners, consumers, or people in the investment community.